Welcome to This Explainer. Today we're diving into a fascinating, high-stakes financial drama that's literally playing out right in front of our eyes. We're going to unpack the hidden mechanics of mega leverage, the anatomy of economic bubbles, and, well, the explosive reality of what happens when those two things collide. It's basically a masterclass in market psychology and systemic risk. We're using real-time market data to uncover just how fragile these systems might actually be. Let's get into it. So, this whole explainer was actually sparked by a viral question from a Reddit user who goes by Dutchbags. They simply asked, at what level does Elon get margin called, "It's good to have a goal in life"? You know, it's a slightly cheeky question, for sure, but what's absolutely fascinating is why it matters so much. It perfectly bridges the gap between internet meme culture and multi-billion-dollar systemic risk. And it sparked this incredibly detailed debate among retail investors and financial analysts alike about the real-time mechanics of massive personal debt. Now, this question didn't just pop out of nowhere, right? It came up because Tesla's stock took a rapid and pretty severe dive. We're talking a 40% drop between December 2024 and March 2025. Think about the sheer scale of that for a second. When a mega-cap company with that much market weight drops that fast, it doesn't just impact your casual shareholders. It starts aggressively testing the structural integrity of the massive financial bets placed all around it. And here is the specific bet we're talking about today. Elon Musk reportedly holds a staggering $19 billion in personal margin loans. Yep, that is 19 with 9 zeros. It's a level of personal leverage that's honestly kind of hard to wrap your head around. But it's not just a giant number, it sets the incredibly high stakes foundation for the math we're about to unpack. To put that into perspective, roughly 1/3 of Musk's total Tesla holdings, which is over 238 million shares, are pledged as collateral. Now you might be wondering, why on earth do billionaires do this? Well, it comes down to a wealth management strategy that's often called buy, borrow, die. See, because their wealth is completely tied up in stock, selling those shares for cash would trigger a massive immediate tax bill. So instead, they just borrow against the shares. It's a highly effective way to access immense amounts of liquid cash, entirely tax-free. But, and this is a big but, it only works provided the underlying stock remains strong. Because when that stock drops, you risk facing the stark reality of the dreaded margin call. A margin call is simply a lender's demand that a borrower deposit more cash or more securities. This triggers when the value of the collateral, in this case literally billions of dollars of Tesla stock, drops below an agreed-upon safety threshold. And look, the lender isn't being malicious here. They just want to make absolutely sure they can still recover their money if the borrower defaults. And this brilliantly illustrates how a dropping stock price dramatically squeezes the borrower. The crucial metric you need to understand here is the loan-to-value ratio, or LTV. Back in December 2024, when Tesla was sitting at roughly $403 a share, Musk's LTV was a very comfortable 20%. The collateral was worth vastly more than the loan itself. But as the stock dropped down to around $241, the value of that collateral shrank dramatically. The $19 billion loan amount, that stayed exactly the same, but the LTV ratio spiked to roughly 33.5%. Now, since lenders typically enforce a margin requirement around the 25% mark, this puts the borrower directly in the danger zone, forcing a massive scramble for cash. Which brings us to the systemic threat that has both financial analysts and retail commentators holding their breath right now. What actually happens if a mega borrower simply can't post more cash? Well, the banks are forced to sell the collateral to protect themselves. This kicks off what is known as a self-reinforcing liquidation cycle. Honestly, this is the exact scenario that keeps institutional risk managers wide awake at night. Let's walk through exactly how this downward spiral works. Step 1. The stock drops. Suddenly, the underlying math of the loan completely changes. Step 2. The LTV ratio exceeds the lender's limit, and boom, that triggers the margin call. The borrower is officially on the clock. Step 3. If that call goes unsatisfied, the bank takes control and forces a massive, indiscriminate sale of shares just to recoup their cash. Step 4, this sudden influx of millions of shares gluts the market, which, by pure mechanics, pushes the stock price even lower. And what does a lower stock price do? You guessed it, it triggers more margin calls for other investors who use that exact same stock as collateral. The panic literally feeds on itself. It creates this vicious downward spiral that is incredibly difficult to stop once it gets going.
Part 1. Anatomy of a bubble, from micro to macro.
Okay, let's zoom out a bit. This single stock liquidation cycle we just looked at, it's actually just a micro example of something much, much larger, an economic bubble. A speculative bubble is basically a period when asset prices greatly exceed their intrinsic, real-world valuation. And it turns out bubbles usually form for two reasons. First, there's excess liquidity in the market, meaning money is incredibly cheap and super easy to borrow. And second, investor psychology shifts toward an irrational, almost invincible sense of optimism.
The famous economist Charles P. Kindleberger outlined 5 distinct phases of a speculative bubble, and breaking them down is pretty fascinating. First, you have displacement, where a new technology or paradigm, like the invention of the internet or, say, the sudden boom of AI, completely shifts expectations. Second is the boom, where prices start to noticeably rise. Third is euphoria. This is where everyone rushes in, rationalizing these totally absurd valuations just because nobody wants to miss out on getting rich. Fourth is financial distress, where the music finally stops. And fifth is revulsion, where the bubble violently bursts and pure panic sets in across the market.
So the absolutely crucial point here is phase 4, financial distress. In this stage, that rapid, easy price appreciation suddenly hits a wall and plateaus. Investors who bought in on heavy margin, meaning they borrowed money to multiply their bets, suddenly realize the math no longer works. They're standing on a terrifying precipice, desperately considering selling just to cover their liabilities before they get entirely wiped out. This is the exact moment where those margin calls we discussed earlier morph from a localized, personal problem into a massive systemic threat.
This whole psychological tipping point is perfectly captured by investor George Soros' concept of reflexivity. It essentially flips traditional economics completely on its head. See, traditional models usually assume that a stock's price is a calm, passive reflection of its fundamental value. But reflexivity asserts that prices actually influence the underlying fundamentals, which then change market expectations, creating a powerful, self-reinforcing loop. Perception literally becomes reality. Let's connect reflexivity directly to the liquidation cycle, which is visualized. Falling prices trigger margin calls. Margin calls force massive asset sales. Those forced sales actually damage the company's real-world valuation by destroying its market cap. That lower valuation creates intense negative market psychology, making banks tighten their lending standards across the board, which chokes off investment and leads to, more falling prices. The market doesn't just calmly correct itself, it actively and aggressively unravels.
And this is exactly why average investors often get entirely blindsided. General equilibrium theory teaches us that markets naturally and calmly correct to a stable baseline. Because we're taught this, we really don't expect the violent overshoots. But reflexivity theory, which has gained immense traction since the 2008 financial crisis, argues that because of human psychology and massive systemic debt, markets actually tend toward disequilibrium. They overshoot wildly on the way up during that euphoria phase, and they overshoot violently on the way down during the revulsion phase.
So how do you spot a bubble before it pops? Well, there are a few classic warning signs you can look out for. You'll see unusual price-to-earnings ratios that just completely defy historical logic. You'll see an elevated, widespread usage of leverage and debt by everyday investors. You're going to hear people rationalizing extreme prices by saying things like, "This time it's different," basically convincing themselves the old rules of economics somehow don't apply anymore. And you'll see high media presence and intense herd behavior, where retail investors buy in simply because an asset is trending on social media, completely detached from its actual business value. Now, what's really interesting about this slide is that when you look at historical patterns, a very clear through line emerges. Take the Roaring '20s, which ended in the devastating 1929 crash fueled by unchecked stock market borrowing. Or compare that to the 2000s housing crash, driven by highly leveraged subprime mortgages. Or even look at the broad-based everything bubble of the early 2020s, fueled by central bank money printing. While the asset types constantly change, from equities to real estate to tech stocks, the key driver remains exactly the same. Excessive debt and extreme margin are almost always the pin that pops the bubble. When borrowing is easy, prices detach from reality. When borrowing tightens, reality bites back hard.
Part 2. What happens next?
Looking ahead, the sources point to a few interconnected global macroeconomic pressures that could trigger the next major shift. First, we have to watch for further declines in localized collateral value, just like the Tesla margin math we unpacked earlier. Second, shifts in central bank interest rates. If money gets more expensive to borrow, leveraged investors feel that pain instantly. And third, the unwinding of global carry trades. Imagine borrowing money in a country where interest is virtually zero, like Japan, and using that extremely cheap money to buy high-flying tech stocks in the US. It's a fantastic trade, right up until the Japanese currency shifts up, and suddenly you're forced to sell everything simultaneously just to cover the spread.
And that leaves us with one provocative, overarching question to ponder, and really highlights why all of this matters to your own understanding of risk. looking at the high-stakes margin loans, the reflexive downward spirals, and the sheer amount of global leverage right now. Are we currently entering the financial distress stage of a broader equity bubble? Is this extreme personal leverage just a bug in the financial system, or has it simply become the system itself? I'll leave you to look at the markets and decide for yourself. Thank you so much for joining me on this explainer, and remember, keep your eyes on the data.